Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and this is a one-year daily candle chart of the Russell 2000 ETF, ticker symbol IWM. As always, I've left my lines on the chart so you can see how the forecast worked out. And if you had a chance to listen to last week's report, you'll know that I left my target price from the previous week up at 185.98. And today, as I record this right here on the 27th of May, we hit that target precisely. And while this looks like we're turning around and the bulls are getting all excited, I want to draw your attention down to the volume down here. Zoom in just a little bit more to show you that while the price is going higher, the volume is still drifting lower. And what does that mean? It means that the buyers were not as excited now as they were at the beginning of the week. You see, this was a hammer pattern here, followed by a bullish engulfing candle. And we just had this beautiful rally, again, as expected. Now, what does that mean for next week? Well, we're at a critical point right here. And I'm not going to remove this line right now. I'm going to draw a new horizontal line that is going to be taken from the next high. And the reason I'm doing this is to point out the importance of role reversal. You see, this line that was broken is now at a resistance point, but I do believe that the market has enough momentum to break out through that. And where will that bring us to? We'll look over to the left over here. See these lows right here? Once that was broken, these were support levels. Once that was broken, it turned into resistance. So there is a chance that we're going to move a little bit higher on Tuesday and Wednesday. So what I'm going to do is just draw that forecast line up. I call these zip lines. I used to call them speed lines, but that became too confusing for the resistance speed lines that technicians use. So that is a zip line. And the end of the line is my target. So for next week, IWM, I'm putting it 192.79. And then just taking a step back, let me give you a longer term forecast so I can help you with this. We were talking about this on a Market Rebellion call not too long ago with our team. And if I were to connect these lines, let me just make them a little bit straight. If I connect those highs and draw those out, and then connect a parallel line to that, we are at the bottom of a trading channel. So again, if you look more closely, you'll see that my target matches very closely to the resistance up here in the trend line. Now, again, to make sure everyone's clear on the terminology, when you have a downward trading channel and we have lower highs, that is the trend line, and the line parallel drawn to that trend line is a channel line. So again, just so in case I use that in the future, you'll know what I'm talking about. So I do believe we're going to go a little bit higher, and then watch out. We could see some more bearish activity come into the market. Now, if I look at the Qs, ticker symbol QQQ, you'll see again, this was a pretty aggressive target from last week, but today we hit that. My target was 303.85. We went a little bit above that. And now that we've hit that target, I'll erase this line, which was my zip line, and I'll erase that target line there and draw the new line up to resistance. So Tuesday and Wednesday, we can possibly go up there, maybe even into Thursday, but you have to keep an eye on that volume, because once that volume starts dropping, the bulls will start to get tired, and there's still a lot of short sellers out there waiting for that moment to strike into a new short position. One other thing about the Qs that I have to mention is that if I zoom in here, you're going to see that we gapped up today. And this is a Marabuzo. There's no shadow below and above, but we gapped up. And so that gap will act as a price magnet once this rally exhausts itself. And so down the road, don't be surprised if you see me set a price target all the way down here. I'll even draw that for you. I don't think we're there yet. We have to wait for the pivot point lower, but I'm going to keep that in place just as a reminder or a bookmark for what we talked about here today. Now, looking at the diamonds, just following right through the major markets, the diamonds, I transferred that target over, carried it over. This was a double hit, by the way. For those of you that watched the report last week, I had put this line as a target the previous week. It then hit it, came back down, and then I left it up at that target. So the diamonds at 325.70 hit that target. And even though we went to a higher high here from the previous high back on the 17th. We do have a long candle, but the volume again is dropping. And one other thing before I draw my zip line there, the volume is dropping, but we have now 5 green candles in a row. That's known as a stale green light. When was the last time we saw one of those? 5 days in a row. It's been a while. See that? We don't have these long stretches of green. I'm just scrolling back to look. We had one back here, and then it sold off a bit. But we have 5 green candles in a row, and the volume is dropping. So to fall in line with the rest of the markets, I'm not going to go as high on the diamonds as the others, but I think we're going to go just a little bit higher, and then I'm going to do a two-parter on you. I think we're going to come right back down to that moving average. And I'm looking to the left as I draw it to the right there to get the right angle. So the moving average is just around 324. And I think that we could pull back to that level with my downside target eventually in this two-part forecast is 324.54. And that will be probably in the first week of June, right around June 9th. So that is the diamonds. Let's hop right to the VIX. To recap, remember, I was talking about gaps not too long ago and how gaps fill. You see that? There's a gap. It filled. Then it reversed. Boom. Hit the target on the way down. See my little zip line right down here? Hit the target right there. What is that target? Let that data box pop up as I hover over there. That's 2701. But look what's happening with the VIX. The momentum indicators are still going lower. Now, this is going to be very important, this part right here. We have a support level here, which is a roll reversal, but I think we're going to go just a little bit lower, not much. But what's more important than the price is the date in which we hit that target. See, if you look straight down, this is a cycle bracket. These are cycle lines right here that we use as a tool. While my downside target for the VIX is 2506, and I showed this to our traders just about an hour ago, I'm going to go back and show you something that's quite amazing, really. And this is a 4-year daily chart. And I'm going to go back some time. Let's go a little bit past the pandemic crash, right? The COVID crash. And I want to show you some of the signals that I'm seeing here for the VIX. I need my little drawing tool to really highlight this. If you look at each one of these cycle lows, you'll notice that had you bought the VIX on any one of those cycle lows, you would have made money. Now, this is going back, since the 2020 crash. You'll see that every single one of these cycle lows wound up with the VIX being higher after that cycle low was hit. Now, is that a guarantee that the VIX is going to go up? No, of course not. I'm just highlighting that at the cycle low. At least by the end of next week, it'll be a cycle low. Keep in mind, I still have my long-term upside target on the VIX at 41.88. I am not moving that one bit. But I'll tell you something, if we start pivoting right on the mark on that cycle low right there, which, by the way, is giving us a date right around, let me see, get that date right there. That is right on June 1st, interestingly enough. All right, so next week, we're hitting the exact mark on the calendar for that cycle low. After that, I think there's a very high probability that the VIX could rally. Why? Because it's an oscillating index. It's not a stock. And then we'll have to see how that affects the market. Remember, the VIX, for the most part, is inversely related to the S&P. So if I'm forecasting for a lower VIX and then eventually a higher VIX, that would translate to be a slightly higher S&P and eventually followed by a lower S&P. So let's go to the SPY, which is the ETF for the S&P 500. Zooming in right there, look at that. And after hours, I do believe we hit that target. Yes, we did. After hour trading, we can officially say we hit that target. Even though we closed below the target, after hours, we got it up over 416. That was again, another aggressive target there for the SPY at 416.51. Now, just like the other markets, I think we're going to go a little bit higher. So I'm even going to continue with this. I'll continue with this upward move right here. And then I think we're going to start to pull back. So this is, again, another two-parter, right? So upside target for next week is going to be 420.90. That's bringing us right around June 9th, actually. But that's 420.90. And then after the pivot point, I think we're coming right back to 405.07. You option traders, a lot of you are salivating at that point right there that we could possibly start moving lower. Well, what does that mean? It means volatility increases, and for option traders, the premiums get beefed up. So if you're trading spreads, the spreads get cheaper. If you're doing calendars, the money comes in a little bit nicer on the short side of those spreads. I'm not going to go too far into that. You could take an option course with us to learn that. It becomes very fun when the markets are so predictable and you're following the technical signals. Is it 100%? No, absolutely not. But what happens is the charts become our best risk manager. Right? It's the best tool that you can use for managing risk. And with that, make sure you are doing just that. One other point before I go talk about the high lows is that today we gapped up again with a bullish Marabuzzo, and we have that long stretch of green, that stale green light. Notice down below, the CCI and the stochastics are both overbought, with the CCI being the most overbought all year. Keep that in mind because the S&P could go a little bit higher, but as soon as you see a little bit of a tick mark there on that CCI, that means all bets are off, or at least you're trailing your stops up on any of the long positions. And again, we have that gap down below the market, which is why I pulled my target down to the 405 level right there. Okay, I mentioned the high-low list. This is a link that I have in the description box below. All you have to do is take a look at what the breadth of the market did today. And if you look at the New York Stock Exchange right here, we had 88 new 52-week highs today, 88. And while that might seem impressive, look down at the 52-week lows. We had about 36 of those. So it was a 2-to-1 ratio to the upside. So the breadth of the market there for the New York Stock Exchange was slightly positive, but take a look. This is why we got to really watch in this market. We had 50 new 52-week highs on NASDAQ, but check that out. We had 116 to the downside. So while the Qs rallied, we still had more stocks hitting a 52-week low than those hitting a 52-week high. There's a couple of other things I want to bring up, and then I'm going to wrap up here. We have the Market Rebellion weekly market report. I have all of you to thank for our success. We had a record number of comments come in, and if you go back last week and look at some of the ones that were mentioned here with Brian, Billy, Jason, look at this, Addicted Trader, right? Read some of these comments because you're going to learn a lot from their experiences. And I do believe that a lot of folks were talking about the risk management part here, which I cannot emphasize enough. Randy, Shirag, these are regulars. Vincent, go back and listen to that so you can see how the progression of forecast worked out. And also be sure, if you're a first timer, click that like button right there. Click that like button, go share it, and then go back to the Market Rebellion channel, and then you will be able to hit the notification bell, and an email will show up, or a text message will show up when the video is ready. Now, my final point, again, has to do with risk management. Last month, I talked about the 3 phases of a bear market. We're still in phase 1. Phase 2 involves a rally halfway through, or almost halfway through the bear market, where we get these bear market rallies. And then phase 3 is actually the most damaging for those who hold on to long positions. That's the capitulation phase. If you look at this weekly chart right now, you can see that that blue line represents the 20-week moving average. You see that? Right now, even though I'm forecasting that high, like I said, you got that channel. But what's happening out there in the world right now? We'll connect the dots. If you notice, earlier in the week, Henry Kissinger made some statements about the Ukrainian government and suggesting that they come to work more on the diplomatic level than on the military level. And his comments came, interestingly enough, the day after they approved the $40 billion package. Now, if you had a choice of spending that $40 billion, and the 2 choices were this: beef up the war, buy more weapons, and continue on and bleed this thing out, or come to a peace agreement, ceasefire perhaps, and use that $40 billion to rebuild the damage or to rebuild the cities that were damaged. If you were the leader of that country, what would you pick? I'm sure there's a middle ground there somewhere, and I'm not going to get into that discussion, of course. But think about this and how the market might react to such a ceasefire. I believe that could happen by the end of June. So be prepared for another knee-jerk reaction to the higher levels. But that doesn't mean the bear market's over, folks. It means we could have a bear market rally on a knee-jerk reaction. And then we have the other variables out there with the Fed, inflation, energy costs, you name it, China perhaps, right? Those are things that are going to weigh in heavily. And again, my other forecast that I made last month was that I believe that in August, the end of August, beginning of September, we're going to get hit with the full brunt force of a recession. I don't see that just going away magically. And so that's only going to weigh more heavily to the downside in the market. So make sure you're using good risk management technique, using stops, learn how to trade options so you're not going overboard and putting yourself into a too high of a risk position. And of course, as always, stay in touch with this weekly market report. Again, thank you so much and have a great long weekend. So long.